The impact of falling crude oil prices has made Ghana's finance minister, Seth Terkper's job a lot more difficult. Government revenue expected to be more than $1 billion has been slashed to just 700 million. Updating Parliament on the impact of falling oil prices, the minister explained the government targets to narrow the country's deficit to 6.5% of GDP from the projected 9.6%.
The fall in crude oil prices, as well as the current energy situation and rapid depreciation of cedi in 2014, could also have negative impact on overall output. As a result, it is considered that taxes on domestic goods and services, as well as non-oil taxes on income and property, could be lower than what the 2015 budget estimated by as much as 358.7 million Ghana cedis. Due to these factors, total domestic revenue for 2015 is now expected to be 27.8 billion, resulting in a shortfall of 3.1 billion Ghana cedis. Mr. Speaker, a factor that is expected to minimize the impact of the decline in crude oil prices, however, is enhancement of grant disbursements following staff-level agreement reached with the IMF.
The initial budget was prepared last year when oil prices sold at $99 a barrel, but government reverted to using IMF projections of $52 per barrel. Analysts say the revenue target was ambitious to start with.
The revenue target was extremely ambitious, and also at the same time the expenditure itself was expected to increase by about 20%. So really, the thrust of fiscal policy is not really clear. If you are looking at a slower GDP growth, you are looking at gold prices not being strong, you are looking at crude oil prices also not being strong, then clearly we should get a budget to better reflect the dynamics of our commodity exports and, of course, the growth of the economy.
Ghana is grappling with huge public debt and inflation. The government is expected to issue a 10-year euro bond worth $1 billion to partly finance its deficit. Valdi Caruso, CCTV.